Okay, good morning and good afternoon or good evening to everyone who's joining us for this webinar on the global economy meets an energy shock. My name is Antonio Fatas. I'm a professor of economics here at INSEAD. And this is a webinar that we have launched a little bit in the last minute as a reaction to what is happening out there in the global economy. And there's sort of news every day on what is sort of changes in the perception of what is happening to the war in the Middle East, to the price of energy, to the price of oil. And we decided that it would be a good opportunity for us to look back and see what is happening and sort of see what is going on in the coming months ahead. Now, this is a situation which is, the world has gone through this before. We've talked many times about supply shock, energy price shocks. We've seen them obviously in the 1970s. We've seen them afterwards. This time, like any other time, is slightly different. It's not exactly the same situation. There's a military conflict that involves, of course, many countries, and there's a negotiation going on about when the war will end. Now, a lot of the uncertainty that is happening today, in particular for people like myself, economists, is trying to understand what is happening to the energy market. It is not just about policies. It is not just about standard economic variables. It's also what is happening, of course, to the price of energy. And there's a lot of confusion when we look at the news about how the energy market works. The signals that we're getting, is the price of oil really going up? What are the future prices giving us versus the current ones? So there's a lot of questions about what is going on in the energy markets. So because of that reason, I decided to invite an expert in energy markets to sort of help me navigate that uncertainty. We're going to talk about the world economy, but we can only do it if we understand better what is happening in energy markets. So it's a great pleasure to introduce my guest today, which is Adi Imsirovic. Adi is someone who I met a long time ago, in fact, playing soccer when we were in graduate school, and then we reconnected at some point. We found each other by pure chance in Singapore. Now, he happens to be an expert in energy markets, so he's the perfect person to have here today. He's someone who has a PhD in economics, a master's degree in energy economics, and he's a guest lecturer at energy systems at University of Oxford. Now, he has a long background when it comes to the energy industry, and he has been in this industry for many years, but he's also been writing about this industry. He's written articles, he's written reports, and he's written a couple of books as well. And I recommend for anyone who's interested in his views that you follow him on social media, because he has great opinions on that. Now, we plan to talk, the two of us, for about half an hour, and then the last 15 minutes will be all about Q&A. So anyone who has questions, please start posting them on the Q&A functionality. We'll be looking at those, and at some point later, we'll be looking at sort of those questions and trying to answer whatever questions you have. So let me pass it to Adi, and he'll do a presentation, I'll do mine, and then we'll have a chat plus the Q&A. Adi?
Thank you very much, Antonio. It's a great pleasure to be here, your guest. I think I apologize a little bit about some noise because I'm at a conference where I was speaking this morning. But the good news, the very good news, is that I'm actually at the Chelsea Football Stadium, and I'm having a pretty good time here with some colleagues. Anyway, we'll start with the energy. We'll go to the next slide. Essentially, I think it's very important to understand how we got here. That's a very good start. Before the war, the balances were actually very, very positive and buoyant. There was an expectation of a huge oversupply, especially in Q2, second quarter of this year. So IEA in February actually projected that there was going to be an oversupply so big of some 4.5 or 4.6, to be more precise, million barrels a day. And if you can see on the chart on the right, that would be a big difference between supply and demand, resulting in building up stocks. And we'll come in a minute, stocks being absolutely essential to driving the price of oil. Next slide. So we were essentially in a situation where we were expecting to have a so-called contango market where the front prices are below futures markets, and the oil price was only about $60 a barrel. Now, we entered the year with exceptionally high stocks. You can see on the chart on the right, IEA, that we got slowly throughout the last year, we're building that stock. and we came up to almost 8.5 billion barrels of overall stocks globally. Now, global stocks, total stocks, are not particularly useful. I think it's very important. So I'll just stop driving the price. I'll just have a few words about that. First of all, most of the stocks, about 7 billion, most of those 8.4 billion, were actually absolutely necessary for the oil market to function, oil system or oil industry. That's essentially oil which is on ships in transit, some minimum levels in tanks, tank farms, oil in the refineries, oil in the pipelines. So that's oil without which the system wouldn't work. Then on top of that, we have strategic stocks, government stocks. So, for example, members of IEA, OECD countries are required to keep 90 days worth of stocks as an emergency supply. And we had, I'll mention that a little bit later on, we had a big release by the IEA, coordinated release. Then we have commercial stocks are the last ones. Those are stocks that are purely discretionary, where companies decide, depending on the price and market circumstances, whether they keep stocks or not. Next slide, please. This is important because now we'll just move to the war, actually, and see what happens. I am not going to bore you too much with details. You've seen that a lot on the news, but essentially the closure of Hormuz shut about 20% of global oil supply. Of course, I'm focusing now on oil. We don't have time to go through everything else, but gas was similarly affected. On the other things like I think Antonio will probably mention a few other commodities, but essentially the key to understanding what's happening is that this is a logistical problem. It's not a lack of oil. It's not a production problem, a logistics. And that's key to prices, which I'm going to actually spend some time on, because there's a lot of misunderstanding why the futures prices didn't follow the physical prices as much as some people felt they should have. In any case, 20%, use some rough numbers, total global demand is about just over 100 million barrels, so easy number to work with, 20% is 20 million. Now, we did not lose 20 million barrels of oil. That's very important to understand. What happens is that the Kingdom of Saudi Arabia have a big pipeline. You can see it on the chart. That's the orange line going from Ras Tanura down to Yanbu in the Red Sea. That pipeline was not used very much other than for local refineries before, but it was built as a strategic asset. Essentially, it ramped up to 7 million barrels. Not all of it was for export, only about 5 million, but that really, really helped Saudi Arabia move most, if not most of its exports into the Red Sea. The second pipeline is, if you look at where the UAE is, there's a little green line. That's a pipeline, so-called Habsha and Fujairah pipeline, that normally carries about 1.5 million barrels, but it was ramped up to about 1.7 million barrels. That really helped the Emirates export a good chunk of their production as well. Also keep in mind the fact that Iran, up until Trump administration put a blockade on Iranian exports, which was quite recent, a couple of weeks ago. Throughout March, Iran was exporting 2+ million barrels. So when you do some simple maths here, you see that we originally, in early March, lost only about 11 million out of those 20. Currently, it's more like 13, because if you add Iranian barrels, 13 and a half, it's very arguable. But at the same time, what was very, very positive is that some other producers ramped up their production. I'll come back to that a little bit later. So essentially, the physical Brent, which is a benchmark dated Brent, TTF, which is a Dutch benchmark for natural gas, the price is roughly doubled, which is a huge hit to the consumers and the economies on which we're obviously going to spend most of the rest of this talking about. IEA came out on March 11th with a huge release of 400 million barrels of emergency oil. It's the largest ever release of oil in history of International Energy Agency. So that really helped and alleviated a lot the situation in the last 2 months. So if you want to use sort of a parallel, an idea of what's been happening in the last 2 months. It's a little bit like somebody who's lost the job, but has got a big fat paycheck. So we continued to use the oil because we had this release. We had some oil coming out of the Persian Gulf through other means, but we were slowly drawing down the stocks, which actually increased prices a lot, and result of which there was some demand destruction. That demand destruction originally wasn't that big. It was only about 2.8 million barrels in March. This is the latest estimate that I could find by JP Morgan. It's about 4.5 million April and 5.5 million expected to be in May if it continues. Next, please. So, impact on the oil market. Well, geographically, the main impact was really on Asia because about 90%, 80 to 90% of all that oil was going to Asia in the first place. Obviously, we can talk about this forever, but the biggest impact was on those Asian countries that didn't have large stocks. And of course, those countries that didn't have large stocks, they are other than, say, North Korea and Japan, wealthy places that where the keeping stock is very, very expensive. Very costly. It involves time value of money, it involves investment, and that security is expensive. And of course, countries like Bangladesh, Pakistan, and so many countries Southeast Asia were really severely hit by this situation. There were some price anomalies as well. Dubai benchmark, which is an Asian benchmark for oil, the governors of that benchmark, if you let me use that word, is S&P 500 or Platts. What they've done, actually, they decided to take out of the price assessment, all the oil that was loaded in the Persian Gulf. So that really decimated that contract by more than a half. And obviously, I think it left it very vulnerable to squeeze. And I don't know if it was real squeeze or alleged squeeze or whatever happened. Nobody can find out until you see the actual data from the participants. But physical Dubai actually traded well over $60 above its own benchmark swaps, which was absolutely massive. Brent actually did something similar, not as much. Physical Brent traded for a period of time in March over $30 over its own futures, which was at the time June futures. And there's a lot of discussion whether it was right or not. Of course, markets are not perfect, and opportunist traders, if they see good opportunity, they will nudge the market a little bit their own way. But essentially, this is, you can see on the right graph, is essentially how market structure works. You would have futures market, let's say in July, which is now the front month. It's loading oil in July, which means delivery in August or even September. And you know what? When you have this kind of crisis that is not supply per se driven, it's a logistical crisis. Nobody's going to worry about September, October. Everyone is worried about now. And this is why Dated Brent was the choice for most traders to actually go and buy very, very, very prompt oil. Of course, there was a bit of sense of panic as well. And I used to supply a refinery before, actually several refineries. And when the refinery tells you we need that oil, you just go out and buy it, whatever you have to pay. Anyway, let's move on to the next slide. Essentially, the volatility was another victim. Normally, oil trades implied volatility of about 30%. It went to well over 100%, 110%. It was huge. The graph on the left shows the WTI. Also, the other thing that made life very difficult for most people who are actually running this, well, now we're talking about real economy that, my friend Antonio is really interested in, is like this. We see the headline figures of the paper market because it's a market that we can all kind of check on the web. We don't see physical markets, but physical markets were a little bit different, quite a lot of bit different. I started talking about dated being $30 at one stage over futures. But on top of that, you have the premiums. So for quality premiums, so for example, Nigerian oil was trading up to $15 over dated Brent. So if you say 30 plus 15, it's $45, almost $50 over underlying paper or futures market. So the refiner is actually paying much more than what you saw on your screens. When the oil was 120, they were probably paying over $150 for physical oil. On top of that, you've got two more factors. One is the freight rates. You can see the graph with tanker rates. Okay, I've used the extreme example here, but actually some of the rates increased fivefold. On top of that, add the additional cost of insurance. So refineries got decimated. Actually, in Europe, refinery margins went sharply negative. So these are all the big impacts. Next slide, please. So essentially, what's been happening? Well, you can spend a long time on this, but you can see the graph on the left. The stocks have been falling because we have been literally eating up the the sort of emergency stocks, and the 400 million barrels in IEA released were eaten up very, very quickly. By some calculation, we shall eat up about a billion barrels of oil by mid this month. And by the end of this month, if you can recall, I was saying there's about 1.4 billion of stocks that we could really use before we really reach the critical levels, what we call operational floor, beyond which actually you get refineries shutting down, pipelines shutting down, and the whole system slowly shutting down. Those critical levels are about 7 billion, and they could be reached if the Strait of Hormuz is not opened sometimes by the end of this month, early June, by some calculations. Then there was a very good paper, by the way, in February in ECB Bulletin talking about non-linearities. That's the level at which these most of the price reactions in oil are non-linear anyway, but particular non-linearities would kick in due to various types of risk. And then as a result, you can see the right graph. I think this is the latest one I could get. This is from Goldman Sachs with various scenarios. The longer this obviously lasts, the longer we are at the critical level, and the more likely the prices are going to go up. And they're cumulative. Obviously, the longer the whole stoppage lasts, the higher the price is. So I would leave to that and pass it on to Antonio, and happy then to chat about any of these issues.
Okay, thank you, Adi. That was very clear, although I think you had a tough task, which is trying to understand what is happening in this market in the middle of all the news that we're seeing as we speak. Again, before this webinar, Adi and I were exchanging messages about what just happening in the market as we're about to start the webinar, and the price of oil is falling because there's expectations that somehow the war will be over soon. But again, we've seen this before. Now the question is whether this is happening again or not. Now, let me share my slides for a second. I'll talk a little bit about sort of the economic side of this equation, which is, given the state of the energy market, what is likely to happen to the economy. Now, I think I have an easier job that Adi has, because in many ways, again, this is a typical sort of oil price shock, and economists like to talk about oil price shocks versus other shocks, supply versus demand. Now, this is the price of oil in real terms through obviously many decades. And those vertical lines are the episodes where the US went into a recession. Many of those recessions were global, so it's not just about the US. And you can see before many recessions, you see spikes in the price of oil. And there's always this idea that the price of oil is crucial to understand some of these events. Now, I'm less convinced about that. It is true that in the 1970s, the increase in the price of oil, of course, is very much linked to those recessions. But when you get to more recent events, say 2007, the price of oil did increase before the global financial crisis, but it was more because of the demand, meaning the economy was growing really fast. And it's not that was the cause of the recession itself. So again, how much prices of oil can cause a recession or not? Again, it really depends case by case. Every time it's different. Now, we're seeing prices going up at the end of my chart here today. Of course, so far, we haven't seen an increase in price, which is that dramatic historically. But again, the point that Adi makes is a very important one. Non-linearities, if this continues for a while, what does it mean? Now, if I think about the mechanics of energy shocks in the economy, again, to me, this is straightforward. For people who import countries that import energy, we become poorer. And I know this statement, you can read it in many ways. People say, okay, inflation goes up, my purchasing power is going down. Sure, the way I read it is a different one. My real GDP, my level of development, my level of wealth has gone down. Now, that means we need to internalize that. And in many cases, internalizing the fact that real income has decreased is harder. And we have to talk about policies. I'll talk about those in a second. Now, those who export oil or energy, if they can export it, and that's a question obviously for the region, you're richer. So this is a positive event, not a negative event. Now, there's an element that affects everyone negatively, which is inflation. So inflation is higher everywhere. But again, in the countries that export oil, inflation is higher, where people in principle could be richer because on average, real income is going to increase. So it's a very asymmetric event. For some people, obviously, the pain is going to be very large. For others, the pain is going to be much smaller. Now, Adi mentioned this briefly. I'm not going to show you data, but there's also an element here which goes beyond the price of oil. There is a question of which energy in which region, which energy at which time, and the fact that there's a set of other commodities that are also going through the same area in the world that are being affected. So not everything is summarized just by one number, the price of oil. Depending on where you are in the world today, the type of shortages we have are very different. And we've been talking on the media about this. Again, it's not so much about pricing, it's about rationing, it's about whether we have enough fuel to fly over the next month or not, and whether the US can provide that fuel or not. So I think there's elements here that go beyond just staring at the price of oil. Now, there's been this analysis, and Adi was doing a little bit calculations like that in some of these calibrations. It's like, how much will the price go up? The price of oil. And here you have sort of two dimensions to think about that. One is on the vertical axis, how long this is going to last. How bad is it going to be? Is it going to last for months? Is it going to last for days? Is it going to be over tomorrow? So as you go down, you thinking of a scenario of a longer event. And then on the horizontal axis, the three columns, the question is how easy is for all of us to adjust? So if we have to adjust to a shortage of X% of the supply, how elastic are we able to be? I mean, can I stop driving? Is that easy? If I see the price going up a little bit, will I stop consuming energy at home? So the higher the elasticity, the first column, the less you're going to see a shock, because then it's easier to adjust. The lower the elasticity, the bigger the shock will be. And these are the type of scenarios we have all been doing with a lot of uncertainty. Why? Because the world has changed. Some of the elasticity we knew in the 1970s was very low. It was very hard to react to changes in the price of oil. Today, we're a lot more elastic. Using those supplies and those resources and reserves that we have, as Adi was mentioning, is a way to add elasticity and stay on the top left corner as opposed to the bottom right corner where things could get very nasty. So intensity, length of the event, combined with how do we think about elasticity are key about scenarios. Now, if you look at the world a few months ago, I think I was showing a slide like this when I did a webinar in this context in January, we've been forecasting business as usual for the next years. Again, for 2026, 2027, we expected the world to grow somewhere around 3 point something. That was sort of what we expected. Now that we bring this shock to the world, how do our forecasts change with a scenario that says energy is going to be more expensive than before? Now, let me show you the scenarios that the IMF just put forward about 2 weeks ago. So the way you read at these numbers, the blue column is the pre-conflict forecast for 2026 and 2027, growth and inflation. Then you have three other columns in green, what they call the reference, the baseline scenario. I'll tell you in a second what that means. And then they have two other scenarios which are more dramatic. Now, here is where my life is very easy, meaning as the scenario gets worse, what happens? Growth comes down and inflation goes up. Now, there's a little bit of a non-linearity. If you move to scenarios which are more dramatic, and the war lasts longer, then growth is going to be affected in a way which is really significant. And we're talking about inflation rates that are going to be a lot higher. Now, these are the aggregate numbers. When you start looking at regions, you get something which is not a surprise. So if you look just at growth, how much has growth been revised? This is the baseline scenario, not the adverse or the severe. So for energy exporters, growth has either not changed or increased for some emerging markets. So EM means emerging markets, LITC, low income and developing countries, AE, advanced economies. For energy importers, you see obviously decreases in the growth forecast. Now, they're not very large in the baseline scenario. We're talking about 0.5 at most. And this is for 2026. Of course, in the region, the forecast has changed significantly. We're talking about a 2 percentage point decrease in growth rate. So overall lower growth, overall higher inflation, and when it comes to growth, very much a very diverse view depending on where you are. Now, let me show you a very similar study done by the European Central Bank, which just focuses on Europe. So Europe is importing energy, so you're likely to see a bigger effect on growth. And they do the same three scenarios, baseline, adverse, and severe. And here you can have a sense of how they think about scenarios according to the price of oil. So this is the baseline. The baseline says, okay, oil has gone up to 90 or more, but it's going to come down very fast over 2026 and go back to sort of baseline in a year's time. Now, what happens to growth? Not much. So growth goes down. You see a little bit of an effect here, but we're talking about 0 point something lower than 0.2 lower than what we thought. What happens to inflation? Again, inflation is here. That's where we are. It goes up by 1 point, and that's it. Now, what if you assume that the price of oil stays higher for longer, say $120, and sort of comes down slower over time? Then growth becomes negative in the euro area. So here's where you see the moment you start pushing the price for a few more months, then the effects are very visible. And then we talk about dynamics, which again, whether you want to call this a recession or almost a recession, that's what you see. Inflation goes up not by 1 point, but 2 points. And if you go to what they call the severe scenario, which is much more dramatic, 140 for the price of oil coming down really slowly, then we have a serious recession. Now we have growth becoming seriously negative for a while, and inflation can go up to 4 points. So again, I think this has been the forecast that the IMF has done, the European Central Bank has done, the OECD. Again, it's all about these scenarios, and it's all about the same story, lower growth in countries that import energy, higher inflation anywhere else. Now, let me say a couple of things about policies and then I'll stop. What do central banks have to do? Well, central banks have to react to increases in prices, inflation, at a time where inflation is higher than the target in some economies, in particular countries like the UK or the US. So that is tough because you don't have any slack. Of course, we throw immediately the word stagflation, which means recession combines with inflation. Again, we're not there yet. You would have to go to one of the adverse scenarios to think about a stagflation, but it could happen if the conflict continues. Now, central banks, in principle, they have the mandate to ignore these supply shocks. Again, that's how we think about it. They're going to be temporary. You don't want to overreact and cause a recession by raising interest rates. But I have to say that this might be a difficult business for central banks today because they did that during COVID and it didn't work very well. During COVID, remember, they said inflation is going to be transitory. Don't worry about it. It wasn't that transitory. So I think there is a question of, are the expectations of the central bank inflation anchor, are they credible? And to me, this is a big question, in particular in some countries. If you look at 10-year interest rates, which is a measure of how much the market trusts central banks, they've been coming up after the war started, both in Euro, in the UK, and in the US. They're coming up a little bit faster in the UK, where I think the signal might be a little bit more worrisome. None of these levels are dramatic. Again, we've seen levels like this before. But if you look in particular the UK and to some extent the US, you've seen half a point or more than a half a point in the UK going up. Again, this is a signal that maybe there's some issue with credibility. If central banks have to fight inflation, it's going to be tricky. Now, let me say just one thing about fiscal policy and I stop. Again, we're going to ask governments, we have asked already, to minimize the cost of the crisis. But one has to be very careful. One cannot deny that if we are poorer, we are poorer. There's no way to just throw money at the problem and pretend that an economy does not need to adjust somehow to this shock. Again, we would like to obviously minimize the cost on individuals, in particular those with low income who have sort of a bigger pain coming out of these energy increases. But at the same time, you have to adjust. And if we need somehow to reduce the demand, keeping the prices stable is not a solution for the short term or for the medium term. Now, that's what I wanted to share with all of you in terms of my thoughts about policy. What we're going to do is two things. Adi and I will have a conversation as I keep reading the questions that I see on the right-hand side, and then we'll go back and forth between some of our questions and the questions that I see there. I'm going to ask Adi a question that I've seen in the chat, but I also have it myself, which is, what is the influence on all this scenario, the fact that the UAE has announced that they're leaving OPEC? Is it related? Does it in any way change the way we think about the medium-term scenario for energy markets?
Yeah, well, first of all, the reasons for leaving, the political and economic reasons. Now, I'm not going to ponder on political reasons. I'll leave it to others. I'm not a political commentator. Economic reasons are, I've done so. One of my students was doing a dissertation comparing UAE with the Saudi energy transition. UAE is way ahead of everyone, all the oil Gulf producers in terms of energy transition. They've been in the renewables for over 10 years now with various companies. So really what they want to basically, they see the light at the end of the tunnel. Basically, they're saying, okay, we see finite time for oil to be exploited. We are going to go full out, produce as much as we can, and invest that money into other things that are far more lucrative, and we want to modernize our place. Essentially, they're saying goodbye to being a petro state. So now consequences. By the way, I think it was in the press. I didn't say it, but essentially, they've been producing a lot less than they could. They've been pressed by the Saudis for many, many years, but they can produce up to 5 million barrels, maybe a little bit less than that, but they produces only about 3.5, 3.7. So that all their capacity was sitting there doing nothing. So, and I think the political situation was just the last straw. The consequences, very important. Short term, none. Mark, you can see it in the market price. It didn't budge at all, simply because we are short of oil. So if UAE want to produce more, great. And also, even if the war stops tomorrow, I think consequences will be relatively muted, because I was talking about close to 1 billion barrels that we need to now restock to build up those stocks again. Our US SPI is particularly only about half full. Anyway, got into the war with half full. So I think that's one big thing. But so very little that we'll notice for the time being, but long term, massive impact. UAE is not a huge producer, maybe up to 4% of the global production, but it's just they are a giant within OPEC. They are one of the, sort of Gulf countries. I used to call them lieutenants of the Saudis. Okay, they are there. They always supported OPEC. I mean, they're hugely important player. So the fact that they're going out now to produce, they were basically saying, we're going full out. For those of you, I've actually been multitasking a little bit while you're talking, Antonio, because I know your presentation. I answered a few questions. There's today in the FT, the ambassador of UAE in Washington wrote an op-ed, an article, brilliant, basically confirmed what I wrote about a week ago, basically saying we see oil just as a means to development, and we want to develop as soon as we can and basically produce as much as we can, which means in the long run, less cohesion within OPEC. Maybe even, beginning, I actually said it could be a beginning of the end of OPEC, but just the beginning. It's not going to happen overnight. And basically a lot cheaper oil in future.
Okay, that's good. Let me pick a question which is both about economics, but also about the energy market. So I'll answer the economics part, you answer the second part. It's a little bit about how pessimistic, optimistic we should be, or we have been over the last days. And clearly, you see online, and when you see actions, you see a little bit the two extremes, right? So you see the extreme that says, again, for the International Energy Office is this is the worst energy shock we've ever had. In particular, when you ask people in energy markets, immediately you think this is going to really at some point explode in front of our face. At the same time, when you look at economic numbers, somebody's asking about the stock market, everything seems to be fine. So the stock market seems to be dismissing everything that is happening. Now, I'll answer the question on the stock market, and I'll let Adi say something about the pessimism about energy markets. Now, to me, the stock market, again, I've talked about this in the last month, certainly in the last year or so. Again, once it starts what it has been doing for a while, a really optimistic view of the future, which is not driven by energy, but driven by artificial intelligence and other trends, it is really, really hard to sort of get their attention into something else. That's my view. This is not investment advice, but it is a fact that you see the bad news. Yes, they hit the market, but there's a tendency to sort of find a way to say, okay, they're not so bad. We're going to be fine. Now, we've seen that over the last years with several events, not just this one, and I'm seeing the same attitude now. Now, it could be that this works. Again, it could be that the war truly resolves over the next days, and this is fine. At the same time, the stock market should be pricing some of the risk. So there is a scenario which everything works, but there's no scenario where everything is so much better than before. So if you have the other scenarios which are risky, something could go wrong. Again, it might be a low probability, but something could go wrong in this event. I think you would assume that the stock market prices some of that risk. Again, I get a sense that we're not pricing risk anymore in the stock market. We're trying as much as possible to think about how can we go back to the baseline, which is this is a great time to invest because we have artificial intelligence. I see a disconnect. I cannot explain it except as much as I said now. And let me pass it to Ari again, just to see, to calibrate some of these really pessimistic views you get from people in the industry, and people on the sort of more the economic side of the stock market seem to say, oh, these guys are too pessimistic. I don't know if you have a view on that.
Yeah, well, thanks for that. I think the interesting thing, I'll just mention a little bit the stock market because I'm obviously as a former oil trader, and traders are not necessarily economists. They just act on base of expectations. And I think one of the probably potential answers is that the administration of Donald Trump is being seen as being friendly to the stock market. And that's one of the reasons I think that the response of the futures market for oil has been so muted because they always believed in this taco trade. You know, Trump always chickens out. They realized, and that may well be unfolding as we speak, because for the first time I saw yesterday in the US, average petrol prices or gas prices, as they say, were $4.50 per gallon. So that's super high, and I think they are responding to that. In terms of pessimism, or actually, before I talk about the sort of pessimism about the oil market, I must throw a little bit of optimistic light. I think this is probably the best advert that renewables have ever had, because right now renewables are equated with energy security, and that's not been the case in the past. In fact, if you look at the old OPEC announcement, there was always like, oh, we are a reliable partner, we are reliable energy, we are there for you to supply you, and suddenly you see where we are. It's not very good. But I think the market may just end up being happy-go-lucky if we end this conflict, because if oil does not come out until the end of this month, somewhere in June, could be seeing some very ugly things. We could be seeing prices easily, I think, over 150 in futures, physical being a lot higher than that. And the consequence of that be terrible, because we're simply down to very low stocks. Especially, I mean, you and I are in Europe, and there was one of the questions about jet fuel. The Middle East countries, their crude oil that comes from the Middle East is very rich in what we call distillates, middle distillates, and that's jet and diesel. So we're using A, the crude oil that's rich in distillates. B, they also export a lot of distillates, especially Europe. UK was a big importer of jet fuel from the Middle East. And that's definitely already, I mean, the flights to the Middle East has been demand destruction. I mean, I think one of the Middle Eastern airlines, I won't name them, announced like 30,000 cancellations. and some flights are being cancelled, and we will see that demand destruction. On another, let me try and be a little bit positive again. I was just speaking about this early on. The first ones to get destroyed demand is you've seen petrochemicals. Okay, they had to basically reduce their runs, less ethylene, and so on. Well, I always throw this positive spin on that. Plastics are not recycled well. We recycle about 70% aluminium, 80% of steel, most paper, most things. Plastics are recycled less than 10%. You know, if we were to recycle plastics to up to 80, 90% like we do other commodities, we could destroy 5 million barrels of demand overnight and actually make the planet look better, healthier, and safer. So I would like to leave that on that positive spin.
Yeah. Yep, that's good. I mean, I'm reading a few questions where people are asking us to predict a few things that are hard to predict. I mean, I see a question about the UK stock market and real estate in the UK. Again, one thing that I want to stress, again, you said it, Adi, and I will say it as well, and this is both from the energy market and the economic side, is the non-linearity. Again, there are scenarios where things end fast and we forget this event as a blip. But if you add another 4 weeks, then the energy market would look very, very different. It's not just a little bit different. We've gone through a few weeks already, but the moment you start adding weeks, we get into territory where things get exploding. And same from an economic point of view. A little bit of inflation is manageable. A lot of inflation is not. So again, when you think about scenarios, unfortunately, that's the way we have to think about it. It's very hard to give it a forecast. It's very hard to think inflation is going to be X. But if you ask me about my concerns today versus a month from now, if we are having the same conversation, they're going to be increasing at a very fast pace. Now, I want to touch on a point that you said, which I think is important. To what extent this could be a catalyst for the energy transition to renewables, right? And I think I see two sides of this. One, yes, and I can see some evidence that in some countries people are rushing to buy electric vehicles. You see an explosion of electric vehicle sales as we speak. At the same time, you also have countries which might do the opposite, at least in the short term, because they feel, hey, this is a wake-up call. I need to have energy controlled by myself. And the closest thing I have that I can control is coal. Again, I cannot do an energy transition tomorrow to sun, to solar. So I'm going to use coal like crazy. So I think you're going to have a little bit of both, right? At least in the short term.
I can just add to what you said. I think I liked 2 points that you mentioned, really important ones. The first point is that I think you said during your presentation that we haven't been here before. And we haven't been here before. This is by far the biggest oil shock ever of all times by a long margin. Okay. Secondly, talking about non-linearities, because being in oil, I've spent a lot of time on these curves, and the curves are not only non-linear, but that those elasticities that you talked about, they also change along the curve as you go along the curve. So supply curve for oil is usually very elastic at the beginning for a long, long way, and then suddenly starts getting inelastic, goes up, and then gets almost totally inelastic at some point. So where demand crosses that supply curve is absolutely essential. You have to know where you are on that curve to actually see the results of that. So I think that's really, really, really valid point. And those non-linearities we are going in line with, we haven't been here. So and I think what worries me, and these are things that kind of it should be worrying about things that we haven't been here in terms of that. This is true also for the climate change. We're pushing the world to a level where non-linearities are equally kicking in. And we just actually, even the best scientists out there just don't know. And just taking the risk, I mean, in real life, you wouldn't do it. If you knew that there were sharks in the sea, you wouldn't go and swim. But we kind of taking chances a little bit too much.
Yeah. Okay. Thank you, Adi. We're right on time. We promise it will be 45 minutes. So we made it all the way. Apologies. There's a lot of questions, some good questions, but we wanted to keep it short so that everyone can continue with their daily tasks today. Thank you very much. Again, we'll continue doing webinars like this for our INSEAD community and anyone else who wants to come. And of course, thank you very much to my guest today, Adi. Again, it was very useful to have him on board. Okay.
Always great pleasure talking to you, Antonio. Thanks.
Okay. Bye-bye, Adi.
Bye bye. Bye.